some people are still logging in here. I just want to give it a couple more minutes so that we have a couple more admittance from the, oh, there we go, those popped up. And the first couple minutes here is just a brief intro. I'm sure that all of you know who I am. I've been to the Arcadia Association of Realtors quite a few times over the past several years. My name is Tony Watson. I work for a company called Robert Hall and Associates. We are based out of Glendale, California. Been here in the Southern California area since 1971. So we're going to be celebrating our 50-year anniversary coming up here in 2021, which is pretty exciting for the Hall family and everybody who's been a part of the exponential growth of our firm over the past 50 years. I am not only a tax advisor, but I am also the keynote speaker for our firm. So for those of you who do know me, you know that I'm the guy who comes and teaches you about taxes, anywhere from estate planning, trust planning, all the way up to the Power of Inc., which is the discussion today, and year-end planning. That'll be coming up in the next few weeks here. This year has been an absolutely insane year, not only from a business perspective, but also from, just everything going on with the election and the pandemic. I mean, we're talking about probably one of the more unique years that I've actually been able to work as a professional through, even more unique than the last recession. So we have a lot of economic uncertainty. I'm sure that most of you watched the debate last night and the first debate, and we've got a couple more debates coming up. Let's just try to keep a level head about everything. I know that we are enduring all of this together, whether you're on the left or on the right, or voting some other way. I don't know what other way you can, right? Right down the middle, so to speak. But we can all agree that we're in this together, that we're enduring this pandemic together, and that we all want the eventual goal of it ending, right? We want this thing to be over. We want people to be safe. We want them to be healthy. But most importantly, we want to get back to some sort of normalcy, right? Well, coming out of this pandemic, as a tax advisor, I foresee a couple things changing in the tax industry, not dealing with the election, not dealing with any of that, but just coming out of the pandemic with the struggles that rental property owners have seen, with the struggles that realtors have seen. In the real estate industry, we're going to see a lot of change. And with that change comes a very important topic of incorporating your properties or incorporating your business. In the past, when I've come to speak at the Arcadia Association of Realtors, I've talked about the importance of separating business and personal assets, because we live in a sue-happy country, we live in a sue-happy state. And so we're going to talk about some of the misconceptions of incorporating today. We're going to talk about some of the major benefits of incorporating, some of the more common mistakes made, some of the most more uncommon things that you see with incorporating, why it should be right for you but not right for others. So we're going to talk about a lot today. I don't know if we are actually recording this webinar, so it will be available. We have other webinars recorded as well on the year-end planning topics, on estate planning. So in the future, if you're ever looking for free educational webinars pertaining to taxes and kind of everything related to taxes, you definitely were the source to come to. So without further ado, let's hop right into it. I know that, once again, you know who I am. You know about our firm. I'm just going to go over some brief, quick information so we can get on to the real meat and potatoes here. Obviously, tax savings during times of economic uncertainty, people want to learn about how to shelter their income and also protect their assets at the same time, simultaneously. But most importantly, we need to talk about the different types of entities that you have to choose from. Some people just jump right into it. They think that an LLC is right for them, or an S-Corp or a C-Corporation. Well, we need to understand a little bit more about those entities before we pick and choose which type of entity we use for the different types of investments we park our money in. So we're going to talk about all of that today. Once again, I work for Robert Hall and Associates. I've been here for 16 plus years. I do individual tax preparation, business tax preparation, won a couple awards in the past. I'm also the keynote speaker, and I speak at over normally 100 plus in-person events per year. This year has been unique. Like I said earlier, most of those seminars have been switched to webinars. And our in-person meetings here at Robert Hall, for instance, have been closed for the foreseeable future, because Los Angeles is still very much, an epicenter or a hot center for the pandemic coronavirus. So we're doing whatever we can to get information out to our clients, to meet with our clients in the most safe and healthy way possible. But we by no means are shut down. We are fully functional, up and running. We have digital platforms to connect with our clients, and we still offer our free consultations, which I'll remind you about towards the end of today's webinar. In the beginning, Bob Hall wanted to start this firm as a one-stop shop for all of your financial needs. Bob Hall still very much involved in the day-to-day operations of the firm. If you ask him, though, the real true founder of the company wasn't him, it was his wife, Janice Hall, very much probably the most philanthropic family I know in my life. They are just wonderful, wonderful individuals, very hardworking, very dedicated to their clients, and so that has spread amongst our firm as kind of the legacy that we need to honor of the Hall family. Even though he's still here working 2 or 3 days a week, when you come by, once we do open up in person, you might see him roam in the halls still. It's pretty inspiring to see him still at the grind. But yeah, and just to kind of tell you that I'm not a one-man operation. I don't work for the Halls and the Halls only. I work with a team here at Robert Hall & Associates. We have several senior accountants that are very knowledgeable in the real estate field, the incorporating field, the estate planning field, the nonprofit field. So when you call in and you discuss any concerns with any of our senior preparers, understand that everyone has an answer for you. When you call in, and if you get a hold of me, great, I'll give you the answer. But if you need an answer right away and I happen to be tied up with a client, just understand that I have a wonderful staff here, very knowledgeable, all trained by one of the Hall individuals. And we are here and ready and available to answer any of those important questions that you may have. We service tax filings in all 50 states. So even though we only have one location here in Southern California, we do actually file taxes all across the US. Very unique part about our firm. We offer, like I said, a number of services, anywhere from tax preparation to payroll services. We incorporate businesses. So if you are in need of starting an LLC, an S-Corp, C-Corp, we can help you start that from the ground up as well. We do financial planning, estate planning, so on and so forth. So I think you kind of understand our operation and how we're basically a one-stop shop for all of these needs. And if you are ever in need of one of those services, reach out to us directly. Today's topics, we're going to talk about mainly the power of Inc., right? Is incorporating right for you? How can you benefit from incorporating either as an LLC, S-Corp, or a C corporation? Also, how do we protect assets by incorporating? How do we utilize LLCs and S-Corps and C-Corps to protect our assets separately from everything that we own personally? And also, is there a potential tax savings benefit for incorporating? And what type of entity do I need to have set up in order to receive that tax benefit? I'm not going to tell you right out the gate, actually, I'm not going to tell you that all entities actually save you tax. There's only one specific type of entity that can actually save you tax, which we'll talk about towards the end of today's webinar. But most important that we need to understand is that incorporating, the number one benefit is not tax savings, it's going to be asset protection. And that's why people look to incorporating for that benefit. They look to separate their business and their personal assets. So kind of jumping right into today's topic, to start off with, let's talk about whether or not incorporating is right for you, because that's probably the most important question to just get out of the way right off the bat. Incorporating is not right for everyone. I want to make that very, very clear. Incorporating might be right for your neighbor, your coworker, your family member, whoever you're talking to about incorporating, but it may not be right for you. It might not be the right time. So remember that when you incorporate, before you incorporate, you need to make sure that it's right for you specifically. So you need to talk with a tax advisor about whether or not an LLC, S-Corp, or C corporation is right for you, or the right financial decision and the right asset protection entity for you to use based on what type of assets you invest in. Look into all assets currently and business ventures that you own and operate, because a rental property will be protected differently than a self-employed business will. They will be two separate types of entities. And so we're going to talk about the distinction and the separation between a self-employed venture and maybe a rental investment, and why you want to use different types of entities for those types of asset protection. Is right now the right time for you to incorporate? Timing is everything. We need to make sure that, one, it makes sense from an asset protection standpoint, but also we need to make sure that it makes sense financially. Is it going to cost you more than it's saving you in certain instances? And so we need to map this out for our clients and make sure that it's the right financial decision for them to make right now in the current economic climate that we're in. Is incorporating right for you in your specific situation? Are you buying property to flip? Are you buying property to rent? Are you selling property as a commissioned realtor, as a real estate professional? Well, each individual will be taxed differently, because those different revenue streams are looked at differently under the IRS's thick microscope, so to speak, under the Internal Revenue Code. Whether it be the old or new Internal Revenue Code, I want to make sure that we all understand that real estate happens to be the largest and most beneficial tax shelter for us, whether it was the old tax code or the new tax code. But remember that your situation, your specific situation is unique. It is different from everyone else's. So just because your neighbor who flips property has a corporation, has an entity set up, does not mean that you should also have an entity set up for your flipping business. And once again, we'll dive into more detail as to why that is in the upcoming slides. What type of structure should you choose? Because there are a lot of options out there. Which one is best for you? So just to kind of throw out a couple titles here, let's talk about the 3 sections that we're going to be discussing today. The C Corporation, we're going to spend a little bit of time on that, not too much time. We're going to talk mostly about the S Corporation and the LLC today, because those are the 2 most popular entity structures that are out there and available for us to start. When you buy property, remember that rental investments are not self-employed businesses. And so therefore, the government will look at them differently from a tax perspective. But also from a legal perspective, you need to realize that when you buy a property, you now own one of the largest depreciable assets that you or I will ever own in our lifetime. And so you want great limited liability protection for that particular asset, where you know that rental income at the end of the day will only ever pay federal and state income tax. So LLCs are great for protecting large assets like rental properties. They are the most popular entity structure for rental property ownership. And they happen to be the most popular entity structure altogether. They happen to be the most used entity structure. So when you go to an attorney and you ask for an entity that's going to provide you great limited liability protection, they're going to set up an LLC for you and have you transfer title of your property into that LLC. When you're a self-employed business owner, the advice is a little different. Sure, you want limited liability protection for your business, but you may also want a tax benefit for your business. So once again, today we're going to talk about the distinction between the LLC and the S Corporation or the C Corporation, and figure out which one provides you not only the asset protection benefit, but potentially a pretty nice tax savings as well. So what real estate investors need to understand, and real estate professionals need to understand about LLCs specifically here in the state of California, is that LLCs on the state side here in California pay a filing fee based on their gross revenue, not their net profit. Okay. So whether you are buying and flipping property, whether you are buying and holding property, or managing property, or rehabbing, or short-term holds, with short-term holds, rehabilitation, and buy and flip, they are all kind of taxed the same way. It doesn't matter what you're doing with real estate. At the end of the day, you need to make sure that, one, you're writing off as much as you possibly can within the 4 walls, essentially, of the Internal Revenue Code, but also that you are structuring yourself to retain more of your wealth, right? Obviously, we all pay some sort of tax. We all pay something to Uncle Sam, to the state of California: sales tax, property tax, use tax. We all pay some sort of tax. But through proper structuring and proper planning, we can pay our obligation in tax and not a penny more than our obligated amount. Those of you who have heard me speak before, you've heard me say that phrase. I truly, truly believe it. By planning ahead, we can pay our obligation in tax and not a penny more than that obligated amount. So if you fall into one of these sectors here, where you're buying and flipping, or you're long-term holding, or you're managing property, or you are receiving commission income for selling property as a real estate professional, we need to understand the differences between the revenue streams, not so much about the entities just yet, the differences between the entities. We need to understand how the federal government taxes each type of revenue source. So whether you're buying and renting out a property or managing property, because these 2 individual revenue streams are looked at differently by the IRS, we need to set up a structure or choose an entity that is the most beneficial for that particular revenue stream. Property management is self-employed income. It is subject to federal tax, state income tax, Social Security tax, and Medicare tax. It's subject to all of those tax because it is self-employed income. Whereas rental property ownership is a little different. Rental property income is only subject to federal and state income tax. It is not subject to Social Security and Medicare tax. So just understand that there's a big difference between those 2. You might end up paying more tax on self-employed income. Well, actually, you will pay more tax on self-employed income than you will on rental income. I think that's one of the main benefits to know as a tax advisor, to know how all of these revenue streams are taxed, so that we can advise our clients, hey, As you grow your wealth, you want to diversify your portfolio. You might want to have a little bit of both. You might want to have a little bit of the rental property side. You might want to have a little bit of the self-employed income side so that you get the best of both worlds. But what types of entity structures should be used for these types of investments? Because I do not want you to leave this webinar and start an entity because you think I said something that pertained to you. I want you to take the information from today's webinar and use it and go to a tax advisor, whether it's us or whether it's your own tax advisor, somebody who's been using for a long time. I want you to sit down with them and map out a strategy for you specifically. Because like I said earlier, incorporating is not right for everyone. The number one benefit of incorporating right out the gate is asset protection. Like I said earlier, it allows you to separate business and personal assets, which gives you greater asset protection. Remember that if somebody sues you personally, they're not necessarily suing your business. If somebody sues your business, they're not necessarily suing you personally. Now, we're going to talk about if they can sue both in a second here, but yeah, that's possible, but we'll get to that in a second, okay? So asset separation equals asset protection and vice versa. And so if you are looking for that greater asset protection benefit, the question to yourself would be, okay, well, now is the right time to incorporate because of the pandemic, because of my increased liability. I'm acquiring more assets. I've inherited property or money from a relative. I have a relative wiring me money from abroad. I mean, there are a number of reasons why you would want to separate business and personal assets. But what entity should you choose for each type of business venture? We do want to mention first and foremost that insurance policies are not going to provide you the same benefit as an incorporated entity. So I want you to take this away as well before we hop in to the LLC S corporation topics. If you are sitting behind your computer screen thinking, well, Tony, I don't need an incorporated entity because I have the greatest insurance policy in the world. I have the greatest insurance rep. I'm with the greatest insurance company. I have the greatest asset protection from my insurance policy that money can buy. Well, understand that insurance by far is the most important thing for you to have. We all have health insurance in case we get sick. We have car insurance in case we get in a car accident. We have homeowners insurance in case our house burns down, right? Well, insurance is by far the most important thing for us to have, but insurance policies do not provide the same level of asset protection as an LLC, S-Corp, or C-Corp provide. Insurance has an actual value payout, right? And I usually ask people to raise their hands in in-person seminars. I mean, how many people actually think that insurance companies are in the business of paying out settlements? I mean, that's a silly thing to think about, but think about that for a second. Let's dive a little bit into detail. How many people have struggled with an insurance payout before? Well, I could tell you that I have personally. I could tell you that some of my clients have. Well, not some, a lot of my clients have, especially my rental property owners, but I see it all the time. We live in a sue-happy country. We live in a sue-happy state. We are, as we build our wealth, eventually you will end up in litigation in one shape or form. It doesn't matter whether you're sued in court or it settles out of court. At the end of the day, you want insurance there to protect you and pay out any settlements in case an unforeseen event happens, right? You don't know that something's going to happen, so that's why you pay for insurance. But insurance policies do not provide asset protection. They are great, and they are tax deductible for the most part under your business ventures, but they do not offer the same benefit as an LLC or an S corporation offers. All right. So I want you to be understanding of that you can have all the insurance in the world, but it does not separate business and personal assets like an LLC, S Corp, or C corporation provides as far as asset protection is concerned. So what entity, now that I have the great insurance policy, what entity should I be looking for in order to protect my businesses separately from each other, my business and my personal assets? Well, understand that if you've already set up an entity, I want you to be aware of this as well. If you've already set up an entity and after today's webinar, you're thinking, well, Tony, you told me that this entity would have been better off for me than the other entity. So do I need to shut that down and start a new entity? Well, no, pump the brakes for a second. Because whether you set yourself up as an LLC, an S-Corp, or a C corporation, there are special elections your tax advisor can make on your behalf to tax you as a different type of entity. Meaning that if you set up an LLC and you rather be taxed as an S corporation, you can make an election to be taxed as that S corporation. You don't need to shut down the LLC and start a whole new entity. If you set up a C corporation, you rather file as an LLC, you can file an election to convert your C corporation back to an LLC for greater limited liability protection and not be subject to the double taxation rules of a C corporation. So understand that if you've already set up an entity, don't worry. If you'd rather be structured differently, a tax advisor can help you convert that. Don't shut down the original entity, wasting all of the money you spent incorporating, and then have to spend all of, thousands of dollars to reincorporate yourself when you could easily just convert one entity to the other type of entity. All right. So let's talk about the LLC first, the most common entity structure amongst them all. LLC stands for Limited Liability Company. And I've asked this a number of times in my seminars, my in-person seminars, what people think LLC stands for. Some people think it stands for Limited Liability Corporation. Some people say Limited Liability Company. Some people don't participate or they don't know. Well, at the end of the day, it's very important for you to know the simple fact of the fact of that LLC stands for Limited Liability Company. And here's why this is important. When you set up an LLC, you don't file articles of incorporation. You file articles of organization. And an LLC is not owned by share, it's owned by percent. And so when you tell somebody that you are an incorporated entity and you sign a contract with somebody and say that you are a corporation, when in fact you're an LLC, what you've done is you've told somebody in a contractual legal binding agreement that you own shares of a corporation, when in fact you may actually not own shares, you may just own an LLC. Now, vice versa, let's say that you say you're an LLC, but you're actually an incorporated entity. Well, technically you're lying on this contract because you do own shares of a corporation. You don't own percent of a business. So you could be in breach of malpractice simply by misrepresenting yourself to the other party that you're going into business with. So just understand articles of incorporation versus articles of organization, very important from a legal standpoint when signing contracts and stating in this contractual binding agreement that you are a corporation, not an LLC, or an LLC, not a corporation. So just be aware of that. Very, very simple topic to discuss, but it's important for you to understand that as you go throughout your business life and career, signing contracts with people. And so obviously the LLC happens to be the most popular, like I mentioned earlier, and it is mainly used for protecting large assets. Well, the largest asset that you and I will ever own in our lifetime, unless we're the inventors of Google, right, will more likely than not be a property, a rental investment. Not a primary residence. A primary residence is a personally owned asset, right? A rental property is a business. And so therefore, as a business, you can deduct the improvements, the insurance, the depreciation, the property taxes. You can deduct anything that relates directly to this business. And so you want to protect that business because it eventually will appreciate in value, and it eventually will pay out a dividend, a consistent dividend for you in retirement if you slowly pay off the debt on this asset. That's one of the main reasons why I invest in real estate, is because it is the most consistent dividend paying investment I can park my money in. Whether the economy is good or bad, people will always need a place to live. Now, in that very, very small percent chance that we are in the midst of a pandemic, which we are right now, some people might not be paying their rent. And at the end of the day, the government has rolled out the CARES Act with the EIDL loans and the PPP loans and things that can supplement a lot of this loss of revenue. And they're working on the HEROES Act. I know that they're bickering back and forth. They just need to make a decision, get money out to the property owners and the business owners, because you generate revenue for the U.S. economy and you create jobs for the U.S. economy. But they need to decide quickly. I read this morning that if they don't decide before Friday, they go on recess. The Senate and the House, they go on recess. Congress goes on recess until mid-November. So something needs to give before Friday. Otherwise, the next month could be pretty interesting. I mean, the year has been interesting already, but the remaining part until the election could be very interesting as well. So, the reason for real estate being the largest tax shelter, the most beneficial tax investment that you can make, is because the IRS and the federal government, whether you're Democrat or Republican, we know that real estate is the true stimulator of the U.S. economy. When you think about purchasing or selling a property, think about how many jobs are created just through the purchase of a property and the sale of a property, or even just through the exchange of a property, right? I mean, when you're exchanging, selling, or purchasing a property, it creates 50, 60, 70 plus jobs. We're not even talking about the contractors leading up to the sale, the contractors after the sale. This generates revenue for the United States economy. So that's why, in my opinion at least, that's why the real estate world provides the greatest tax shelters for taxpayers here in the US. Now, LLCs, along with this great investment that you're parking your money in, you want to protect that as you grow your wealth in real estate. And so LLCs are great for limiting liability, but guess what? LLCs provide absolutely no tax benefit for you, provide absolutely zero tax benefit. okay? That's one thing that I want you to take away from the LLC structure. It only provides limited liability protection. It does not provide any sort of tax sheltering benefit. Now, remember, kind of along that same conversation, in order to achieve greater asset protection, what do you have to do? You actually have to put the assets that you want protection for into the LLC. That brings up a very important conversation, though. If you have leveraged your credit to borrow and buy this property, remember the bank loaned you personally the money. The bank did not loan an LLC the money. The bank did not loan a corporation the money. The bank loaned you personally the money. So before you transfer assets into an LLC or a corporation, you need to check with your bank, your financial institution, to make sure they're okay with you transferring title. That's very, very important, because if you start manipulating or changing ownership of an asset that you don't actually own, that the bank actually owns because they're the ones that leveraged the money against it or put the debt against it, they could call the loan due and payable in the next 30 days. If they find out that you transfer title without getting the go-ahead from the bank, from the financial institution. So you don't want to go down that road. Some banks are very real estate savvy, real estate investor savvy, and so they'll have you sign a waiver of liability saying that, hey, even though I transferred the property here, I personally am still held liable for this debt. So there are some checks and balances that you need to make sure, T's that you need to cross, I's dotted, before you transfer that asset into your entity. But at the end of the day, that's really the only way that you're going to achieve greater asset protection. If I set up an LLC and it doesn't own anything, what's the point of me having the LLC? I have to transfer the asset into the limited liability company in order to achieve this great asset protection. And that's what truly allows you to separate business and personal assets. Now, like I said earlier, could you be sued both on the business level and the personal level? Sure. At the end of the day, if somebody has enough money, has enough time, has the right legal representation, they could very much come after your business and your personal assets. But at the end of the day, here in the state of California, they have to file in a court of law a charging order to pierce that corporate veil, to come after the assets. And then at the end of the day, they have to have the money, the resources, the time in order to pursue you on both levels, which, make no mistake, it takes time, it takes money, it takes a lot of effort to pierce these corporate veils and also come after the individual personally. A charging order can be filed on four separate occasions: either illegal activity, which is a given, malpractice, which is somewhat a given, ignorance, and negligence. So if you neglect your tenant, if you ignore their requests, or if you just throw up your hands and say, well, I didn't know that I needed to make sure that the roof didn't have holes and it leaked into the bedroom and then mold started growing. You can't just throw up your hands and say, I didn't know that, right? So you have to understand that these types of things can be, if proven in a court of law, they can pierce that corporate veil and come after all of the assets in the corporation. But once again, they need the correct legal representation. They need the time. They need the money. They need all of these things in place in order to pursue you, and to make it worthwhile for them, and to also make it worthwhile for the attorney. Because remember that all of this costs money. You got to pay an attorney. It has to make sense from a financial standpoint in order to pursue somebody. And an attorney normally will throw up roadblocks and say, hey, listen, you're going to end up paying me triple what you're going to get paid out at the end of the day, because the asset is over leveraged, because they don't have the right insurance policy in place. Now, they could tie you up in court for a long time, but at the end of the day, this is why you always, as you build your business, you need to have great legal representation for yourself. Not on retainer, unless you're a big business owner, you probably want an in-house counsel, but you probably want Legal Shield, or you probably want to talk with an attorney that you've been working with for a very long time and make sure that they understand your financial structure, your investment portfolio. Somebody who understands real estate, somebody who understands the real estate world and how certain lawsuits can bring more heat to your table than other types of legal battles. So just keep that in mind. Great legal team, very, very important. And as it is to build a team all around you: tax advisor, real estate professionals, coaches, legal advisors. This is a very important part of doing business. And remember that as a business owner, as a rental property owner, any cost that you incur that pertains to that business, guess what? It's a tax write-off. See, 2018 might have changed a lot about the old tax code, because the new tax code was introduced in 2018, but it didn't change very much for the business owner or the rental property owner. See, you as a rental property investor, as a real estate professional, you own a business. And so therefore, under the new tax bill, which is very pro-business, you are allowed a majority of your expenses dollar for dollar, as long as they pertain to the business that you are conducting. So keep that in mind. And that's where a good tax advisor comes into play. We advise you as to what is a great tax shelter for you, what you should be spending your money on, and more importantly, to do a little bit of year-end planning. In the last 2 months of every tax year, in November and December, I'd say that we're just as busy as tax season sometimes, because we need to get our clients in to put a plan in place and strategize and implement these strategies before December 31st, so that you end up paying your obligation in tax and not a penny more than that obligated amount. Very, very important to strategize and plan ahead. Remember, failing to plan in the end is ultimately planning to fail. Always remember that phrase. I love that phrase because it goes hand in hand with what I do as a professional. Put a plan in place so that you don't fail, right? That makes sense. So failing to plan is ultimately planning to fail. Keep that in mind, write it down, get it tattooed on your arm. I don't care what you do with it, but that is such a huge thing to understand when operating a business. Always, always, always plan ahead and strategize. When you invest in real estate, like I said earlier, one of the greatest parts of real estate is that the asset will continue to appreciate and somebody else will be paying off your debt for you. So, and at the end of the day, on your rental income, you'll only ever have to settle up with Uncle Sam in the state of California. You will never actually have to pay Social Security and Medicare tax on your rental income. Well, Social Security, Medicare tax alone is 15.3%. And you're thinking, well, that's not a whole lot of money. 15.3% of any dollar is a lot of money. If we're talking about a dollar, that's 15 cents. Okay, I get it. If you're talking about $100,000, that's $15,000. That's a quite a bit of money. So when you build wealth in real estate, one, the federal government still has a number of benefits for rental property owners. Number two, somebody else is paying off your debt. Number three, it continues to appreciate in value, and you will only ever have to pay federal and state income tax on the growth of your real estate valued investments, which is a huge benefit. So you do not pay self-employment tax, unlike the realtors in the room, the real estate professionals in the room, where on your commission income, depending on how much you make and how much you spend, at the end of the day, you pay federal tax, state income tax, and that nasty 15.3% of Social Security and Medicare tax. So just be aware that there is this added tax implication for you that forces you to contribute to Social Security and Medicare on all of your self-employed earnings. And that's where it leads us into our next topic of the 1120 subchapter S corporation. So the LLC, once again, to kind of summarize, LLCs provide no tax benefit, zero tax benefit for an LLC. But if an LLC elects to be taxed as an S corporation, if you are self-employed, right, not the rental property owner, but the self-employed real estate professional, the realtor, by electing S corporation status, you may allow yourself to reduce your self-employment tax by upwards of 60+%. Now, how the heck does that work? LLCs, no tax benefit. S corporation, yes, but only a tax benefit for the individual who earns self-employed revenue. So how is the S corporation going to achieve this? How is it going to help you reduce self-employment tax? Well, the first thing that we need to look at is how you pay yourself, or how you are labeled under Internal Revenue Code. As an S corporation, you are no longer defined as a self-employed individual, even though you pay self-employment tax. By definition, you are no longer self-employed. See, under an S corporation, you are now an employee of your own corporation, and employees don't receive 1099s, do they? Employees receive W-2s. And so this is where the magic happens. You actually are required to pay yourself as an S corporation. Let's say you're a realtor, you've been working in the real estate industry for a long time, your commission income is $150,000, $200,000+, you have your expenses. Well, as a self-employed individual, a non-incorporated individual, you pay federal, state, and self-employment tax on all of that money. Let's say you take that next step to incorporate yourself, and now you're filing as an S corporation, and you've got a certain amount of self-employed income. Well, as an S corporation, you are no longer a sole proprietor. You are no longer a single individual working under your Social Security number as self-employed. You now have to be an employee of your own corporation, and employees have to pay themselves a W-2. And like I said, this is where the magic happens. So by paying yourself a W-2, you are actually allowing yourself to control the amount of self-employment tax that you pay, except it's not called self-employment tax anymore, is it? It's called payroll tax. So by paying yourself a reasonable salary, you are controlling the amount that you are contributing to Social Security and Medicare. So you don't have to pay yourself as a corporation. You do not have to pay yourself 100% of your profit. You can actually pay yourself what's considered to be a reasonable salary, which can be as low as 40% of your overall net profit. Well, I mean, shoot, 40%, Tony, that seems very, very low compared to what you're generating. I mean, if I'm making $100,000 in profit, you're telling me that I only have to pay myself 40,000 bucks? Yes. And that's not only me telling you, that's the IRS telling you. That's the IRS telling you that you can play this game. It's called the reasonable salary ruling, which allows you to minimize your salary as a real estate professional and only be subject to self-employment tax, now called payroll tax, on what you've taken as a salary, and anything that's left over as company profit, you avoid, not evade. Tax avoidance is legal, tax evasion is not. So you are now properly avoiding Social Security and Medicare tax on the leftover profit. Well, Tony, break that down for me. Okay. So let's say that your net revenue is $100,000 and you have to pay yourself on W-2 $40,000, 40% of your net profit. Well, $100,000 in net profit, you get to deduct your $40,000 W-2. That leaves you with a leftover profit of $60,000. And what you've just achieved here is you've avoided, not evaded, but you've avoided Social Security and Medicare tax on $60,000. Tony, I still don't understand. This is so confusing. I don't understand. I am self-employed, but I just don't get how this all maps out. Great. I have it all mapped out for you. I grew up in a household with not only two parents who were real estate investors, but also parents who were two college professors. My mother still teaches at the college level. My father is retired, manages his properties, both commercial and residential. So I grew up in a household that kind of slept, and breathed real estate and small business. And so let's assume that so I'm going to use the chalkboard. That's why I said my parents are teachers. The chalkboard, it's a perfect example of how we all learned at one point, right? And so let's say that your business is netting, right? This is after all of your expenses have been taken into account. Let's say that your business nets a profit of $100,000. We're going to talk about how the sole proprietor or even the LLC is taxed, which, remember, like I said earlier, LLCs have no tax benefit, 0, 0, 0. So you might as well, for tax purposes, you might as well file as a sole proprietor. The only thing that the LLC does is it provides greater limited liability protection. Under an S-Corporation, you get to play the reasonable salary game. And so this is how it maps out. Let's assume that $100,000 of profit for a sole proprietor, average tax rate, let's assume, is 25% federal, 9.3% state, and then you have this nasty self-employment tax of 15.3%. So in your mind, I'm assuming that behind your computer screens right now, if I could see all of your faces, I assume that you're thinking, well, what the heck is the point of working? Don't think that way, by the way. I think that's that's a very strange way to think, because at the end of the day, there will never be a time where you'll pay $1 in tax for $1 earned, right? Even though you're paying a lot of tax in this situation, you're still walking away with earned revenue. But I understand your feeling, because when you add all of this tax up, that's a lot of money that you are not able to keep, right? You're not retaining wealth at that point. And this is one of the main reasons why the general public doesn't like corporate America. They see all of the corporate tax shelters. They see that Donald Trump, the president of the United States, pays $750 in tax. But have you noticed that people are also asking, well, how do I get to pay that little in tax? Right? They're angry about it, and he's a billionaire, right? So you think that he's going to pay his fair share of tax, which I'll explain that to you in a couple minutes. Once again, I'm not going to go into politics, but I'm going to explain to you, kind of open up the curtain, so to speak, to the Wizard of Oz reference, right? I'm going to open up the curtain and tell you exactly how he achieves that. Because much like yourself and much like myself as real estate investors or real estate professionals, at one point before he was president, he was a real estate professional, right? So he understood, well, not even him, his teams of accountants that he pays, they understand how to utilize corporate tax shelters for tax savings and how to use real estate specifically as an asset for tax sheltering. So as a sole proprietor LLC, obviously you're going to pay the maximum tax rates across the board. Now, as a corporation, as an S-Corporation, remember that it's not really, no matter how you split the $100,000, it's not going to change the fact that your profit was $100,000. So the federal and the state income tax amounts stay the exact same, because when you add up the W-2 and the leftover profit, it still adds up to $100,000. But look what happens to your self-employment tax. See, on $100,000, when you get to control the amount of salary you pay yourself, you are able to control the amount of self-employment tax, now payroll tax, that you're paying to Social Security, Medicare, state disability, unemployment insurance, all of the social pots that people will eventually collect from. In fact, that a lot of people are collecting from right now, correct? So on a $100,000 profit, just by filing as an S corporation and only playing the reasonable salary game, right out the gate in this example, you are reducing your Social Security and Medicare tax, your self-employment tax, by upwards of just shy of $10,000. So about $9,200 is what you're reducing in Social Security and Medicare tax. For some of you who are thinking, well, I'm not nearly at $100,000. This doesn't really apply to me. Well, cut that profit in half. Let's say that you're at $45,000 to $50,000. The net savings, the yielded savings, is roughly about $4,600. So the next question is, okay, well, does that make sense? How much does it cost me to file as a corporation? Is it going to save me more than what it's costing me? And that's the financial equation side of things, right? We know that whether you're an LLC, S-Corp, or a C corporation, you achieve great asset protection. But how much is it going to cost you to operate your business as a corporation? Well, industry average to operate an S corporation with reasonable salary payouts, payroll, tax preparation, year-end planning, you're looking at industry average of about $2,000 to $2,300 per year minimum, depending on who you utilize. If you go to one of the big 5 firms, it could cost you $5,000 to $10,000 to prepare a return. You go to a firm like ours, yeah, industry average on the year, on the annual side of things, could cost you $2,000 to $2,300. But remember that at $50,000 of profit, it's saving you $4,600 in tax. It's almost saving you double what it's costing you. And I know that sometimes it's hard to stomach paying for something like that, right? But when you pay something and it's tax deductible, and then it saves you, just by you paying that up front, it saves you double what the actual cost was. Not only is it a tax write-off for you, which saves you money, but it's also going to reduce the tax by double the cost that you originally incurred. See, financially speaking, it just makes sense, but only if the timing is right and if the numbers make sense. I think that as business owners, as real estate investors, whether you're a realtor or a property owner or a property flipper, I think we can all agree that numbers are not arguable, right? Numbers are what they are. And so in the tax industry, we are all numbers, baby. I mean, that's what we are. We're all about dialing in the figures to make sure that it not only makes sense from an asset protection standpoint, but most importantly for you as the taxpayer, it doesn't make sense financially. And so in this instance, at $100,000 profit, absolutely. At $50,000 of net profit, it still makes sense. But we need to dial that in and make sure that it's going to save you more than it's costing you. And remember, the S corporation is only for the self-employed industries, not rental investments. Rental income doesn't pay self-employment tax. So you would never, ever, 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 ever put rental investments, long-term rental properties into an S corporation. You would only put self-employed businesses, property management businesses, self-employed realtor commission businesses into an S corporation because it only saves you self-employment tax. It does not save you federal and state income tax. One other thing that did change for the self-employed individuals, whether you're a rental property owner or a self-employed business owner, in 2018, the federal government, the IRS, introduced something called the QBI deduction, which actually potentially made 20% of your rental property cash flow and or 20% of your self-employed income tax-free. So imagine if you're making $100,000 of profit, right, through your business, the QBI deduction, which has only been available since 2018, made $20,000 of $100,000 tax-free, meaning that you were no longer paying tax on $100,000, you were only paying tax on $80,000. Now, the QBI deduction, I've introduced this a number of times in my webinars and my seminars. You just want to make sure that before the end of the year, you put a plan in place to spend certain monies on either your rental property investments or your self-employed businesses to get you below the qualifying thresholds, because not everyone will qualify for this benefit. I do want to make sure that everybody understands that. This benefit is only for the rental investor, so people with non-passive or passive income, and only for business owners. But your income has to be below a certain threshold in order for you to qualify for this benefit. So just keep that in mind, okay? Now, kind of wrapping things up, I want to make sure that you all understand that as a tax advisor, this is information that I've studied for years. I mean, I've been here for 16 years, okay? It's information that our senior preparers know like the back of their hands. I don't want to send you home with misinformation ever. And so I want to really, really push you to sit down with a tax professional and map out a strategy that's fine-tuned for you, not fine-tuned for your neighbor or your coworker or your family members, because their tax returns are different. They're unique, just like your return is unique. And so 10 years ago, we started offering here at Robert Hall & Associates free 30-minute consultations. We offer them normally in person, but because of the pandemic, we're doing everything by Skype, FaceTime, Zoom, phone, however you want to connect with us. But this free consultation is to review 2 years of tax returns. It's to check to see if you qualified for any of the benefits that you were allowed that were given to you beginning with 2018's tax reform bill, and to check to see if there are any things on, any little deductions on your return or mistakes on your return that could potentially increase your risk for audit. We'll also put you on a periodic tax email update, which lets you know about upcoming changes with the potential HEROES Act, some of the relief plans that the federal government happens to be talking about now, and then also to update you on changes to the actual Internal Revenue Code. Whether or not you're interested in that is a different story. If anything, it might help you sleep a little bit better at night, knowing that you have some reading material that can help you shut your eyes a little bit faster, right? But at the end of the day, taxes are a very important thing. I'm not asking you to know what I know, but I'm asking you to put at the front of your importance scale the importance of year-end planning, the importance of tax planning, the importance of estate planning, and incorporating and corporate planning. This is very important. If you are in the business and you want to retain wealth, you want to keep as much of your money as possible, you need to take advantage of all of the codes under the IRC currently that retain wealth for small business owners. Obviously, the more money you make, the more the strategy helps you. But we all know that famous phrase, it takes money to make money. It wouldn't be such a famous phrase if it wasn't true. So when you talk about a Trump paying $750 in tax, I promised you I'd talk about this. When you talk about somebody who is that wealthy and pays only $750 in tax, what the media fails to understand is that, one, they're not tax professionals. Everybody in the media, everybody out there kind of talking about his tax return and mentioning the one fact that he paid $750 in tax, it frustrates me. Once again, I'm not going to say I'm a Republican or a Democrat. I really don't care what party people are. At the end of the day, a tax return and an analysis of a tax return should only be discussed by a tax professional. It's kind of a disgrace to the license that I hold that these media personalities are talking about something that I spend thousands of hours educating myself on every year. And so understand that $750 of income tax doesn't mean anything compared to what a C corporation may pay or what a wealthy individual will pay in something called alternative minimum tax. I know you've heard me discuss this before in our webinars. AMT was actually a separate tax for the wealthy. Now, I can tell you right now that as soon as Donald Trump's personal income increased and went north of about $175,000 to $200,000, which is well above that, obviously, he became subject to this alternative minimum tax. AMT for him, once again, until he releases his tax returns, I won't really know, but AMT in his situation, because I've run the numbers, I've run an analysis of all of this, the AMT has to be in the millions and millions and millions of dollars, because there's no way that you can have AGI, adjusted gross income, over a certain threshold under the old tax code where you didn't pay alternative minimum tax. So what they're actually talking about $750 in tax, and once again, we'll have to wait and see his actual tax returns when they're released, but that $750 might only be his federal income tax, the stuff that very bottom line that we all pay at the end of the year. See, most of us won't pay alternative minimum tax. I didn't even pay alternative minimum tax in 2019 and 2018, or even in 2017. You have to make well into the $300,000-$400,000 range in order to be fully subject to alternative minimum tax. And at $1 million, $2, $3, $4, $5+ million, your AMT could be hundreds of thousands, if not millions and millions of dollars. And that's just on the individual tax return. See, also when you're a billionaire, you have C corporation tax returns, which actually don't pass through to you individually unless you take a salary from a C corporation. See, C corporations are also known in the tax industry as double taxed entities, where the corporation pays a tax and then the individual pays a dividend tax. Well, if Trump took a dividend from his corporation, the tax rate on a dividend, just like all of the other wealthy investors of the world, when they take dividends from C corporations, dividends are only subject to 15% tax. That creates a flat tax for individuals who own billion-dollar C corporations. Now, C corporations pay under the old tax bill a 35% tax rate. Now, under the new tax bill, they pay 21%. But imagine this. Let's say that we own a C corporation and the net revenue under that C corporation is $100 million, okay? $100 million. I, as a C corporation owner, do not have to take a single dime of salary. We've seen Steve Jobs do it. We've seen Mark Zuckerberg do it. We've seen a lot of the CEOs around the globe take $1 W-2s, okay? So under a C corporation, I am not required to take a salary like the S corporation is required to pay, a reasonable salary. So imagine if we own this $100 million profitable C corporation right out the gate, it pays $21 million in tax. And let's say I only take a $10,000 dividend. I don't know why I would take a $10,000 dividend. I don't have to, but let's say I do take a $10,000 dividend. Guess what? My tax is only $1,500. So at the end of the day, that's one particular example. But also back in 1954, the Internal Revenue Service, which Trump was 8 at the time in 1954, by the way, so I doubt that he wrote this part of the tax code. And once again, I'm not supporting Trump in all of this. I'm not supporting anybody. I'm just merely stating the facts. In 1984, a part of the Internal Revenue Code was written called Section 1231. And Section 1231 took real estate, rental property investments, business rental properties, and allowed them to be losses against rental properties under Section 1231 to be dollar for dollar tax deductible in the year of disposition. Now, over the years, it's changed a little bit, and obviously with inflation and increased numbers, the tax code is altered. But back in 1954, real estate investors were starting to receive major tax sheltering benefits. And then they introduced, I forget what year this was in, but between 1954 and now, they introduced something called 4797 business losses, where if I disposed of a rental investment, and I disposed of it, and because my AGI, which Trump's AGI has always been over $150,000, let's say, because my AGI is over $150,000, I've never been allowed any loss deductions through my real estate portfolio unless I check the real estate professional box. So if I've owned property, let's say that I'm not a real estate professional and I've owned property for 20, 30, 40, 50 years. And because of the expenses, the improvements, cost segregation, mortgage interest, property taxes, depreciation, let's say that after all my expenses, I've always shown a loss through my rental properties, but I've never been allowed the loss as a deduction. It's become part of this unallowed passive loss carry forward. Well, Section 1231 that was put together in 1954, in 2020 and 2021, when I dispose of that Section 1231 investment property, and let's say I had $200,000, $300,000, $400,000, $500,000 in losses suspended because I was never allowed to take them. In the year of disposition of Section 1231 property, Section 4797 of the Internal Revenue Code allows me to dollar for dollar deduct that $400,000 or $500,000 loss against all of my income, not just against the rental property income, not just against interest income, not just against dividend income, not just against Social Security and unemployment and all of the other income sources, not even just W-2 income, all income. So Section 1231 is one of the true culprits of what's going on in today's media. I don't know why people aren't discussing that. And maybe it's because, like I said earlier, the people talking about it, they're not tax professionals. See, and that's why I feel very privileged to know what I know. That's why I feel privileged to work for a firm like Robert Hall & Associates, to work with the individuals that I work with, because we know right out the gate that whether you are entering into real estate or exiting out of real estate or continuing straight down the line doing 1031 exchanges of real estate, that real estate will always, number one, be the true stimulator of the US economy. And number two, real estate will always be the most beneficial long-term appreciating asset. And let's say, heaven forbid, you need to exit out of your investments, it still has and will continue to have, under the old and new Internal Revenue Code, the best exit tax strategies. And so once again, just take everything tax related. I don't care about all of the other jargon that people are talking about on the media. When they talk about taxes, take it all with a grain of salt and realize that the people who are talking about it, they are not tax professionals. Just before I continue to wrap up, I actually saw an interview. I think one of the news stations actually tried to bring somebody on who was a professional to talk about taxes, but they didn't even actually say if they were a tax accountant. They said they were a professor, not even a professor of taxation, just a professor. And so to me, when people talk about taxes and they're not licensed tax advisors, it is very much an opinion, because they have not spent thousands of hours educating themselves on the old and new Internal Revenue Codes. So once again, keep that in mind just as you go through life over the next month. over the next year, over the next 10, 15, 20 years, understand that real estate will always and forever be the single greatest investment you can park your money in. It is the most common investment amongst the 1%, and it should be the most common investment amongst middle America and even individuals who are trying to catapult themselves into the middle income ranges. But you know, once again, owning real estate, it's a privilege. In a lot of cases, it's not a right. I truly believe that not everybody should own property, because some people don't understand the financial obligation, the leveraging against the banks to borrow to buy property. And there are already great plans in place to allow individuals to own property and pay very, very little upfront to own that investment. But real estate by far is one of the greatest investments that we can hold in our lifetime. And so I just want to kind of end on that. So once again, 30-minute free consultations in person, over the phone. Well, actually not in person right now, but over the phone via FaceTime, via Skype, however you want to connect with us. Oops. And I wanted to mention that this is how you go and sign up for the free consultation. I did type my email into the chat box, by the way, TonyWatson@RobertHallTaxes.com. If you are interested in signing up for a free consultation, you can either shoot an email directly to TonyWatson@RobertHallTaxes.com, or you can go right now on your computer, on your phone, to www.roberthalltaxes.com/consult, and you type in your name, your information, and that's how we set you up with the free consultation. We do not solicit your information to third parties. We do not send that out. We do not put you on spam emails. We don't do anything but set you up with the free consultation. If you would like to be a part of our email updates as a firm to let you know about upcoming free educational events, webinars, the free consultations, we can absolutely add you to that email list, but we are not going to immediately add you in case you don't want to receive those emails. So we are here and available as often and as possible as we can, especially during times of economic uncertainty. We are here to educate and educate alone, as well as offer our services, but services come second here, especially with these webinars. And so we are here to educate first and foremost. And I want you to leave here today with a little bit more information. If you got a lot of information, great. If you got very little information from this, I apologize. And I'm going to have a number of webinars coming up where I guarantee you'll take away a lot more information. But this is really meant to educate you and to really allow you to take a stronghold of your personal financial situation and understand a little bit about what the tax code has built into it to benefit you as a business owner, as a real estate investor, as a tax-paying citizen of the United States of America. So I'm going to open up the chat room a little bit for some questions. I do have to jump to another appointment in about 10 minutes, but I do want to make sure that I answer any questions. So the chat box is open. If you guys want to go ahead and start typing away, I can answer simple questions. If there's a complicated question, I'd much rather, have us talking to you not in person, but over the phone. So I'll try to answer them in the most efficient way possible and get you as much information as possible through this little chat room box. For those of you who have to go, you can now exit if you'd like. The webinar is being recorded, so we'll go ahead and make sure that that's available for you. Oh, thank you, Austin. For the S-Corp taxation, for the remaining $60K, where can that go? Does it go to me or stay with the business? Great question. So the greatest thing about an S-Corporation is it's also known in the tax industry as a flow-through or a pass-through corporation. So that $60K, Austin, is yours. You can either leave it in the business, you can take it out, you can do what's called an owner draw, because remember that on the $100,000 example, you're paying federal and state income tax on the full 100K, but you're only paying self-employment tax on the $40,000 salary. So because you've already paid income tax on the full 100K, that's $60,000. It can stay in the corporate checking account. You can draw it out of the corporate checking account. Once you draw it, you can transfer it back in. That's the great thing about the pass-through entities is you can do owner draws of this K1 $60,000 income, this flow-through profit, and not be subject to Social Security and Medicare tax on it. That's the whole benefit. On that $60K, you avoided 15.3% of Social Security and Medicare tax. So that's yours. You can draw it at any time. Most people will tend to leave it in their corporation because that's where they spend most of their money out of. Remember, we want you to spend all of your business expense deductions or expense them through the corporation. So having that personal income in your individual tax return, you might want to draw it out for a short period of time, maybe to qualify for a home loan, rather than having to show a lender that you have all this money in your corporation and a CPA having to write a letter saying that you can access that money at any time. You might draw it out, let it weather in your personal checking account to purchase a property. And as soon as the dust settles, you could transfer it right back to your corporation. No harm, no foul. Okay. But that is yours. It can stay with the company, it could stay with you personally, doesn't matter. It is a pass-through entity, and you've already paid income tax on that $60,000 at the end of the day. All right, Austin was the last question. Anybody else? Oh, perfect. As a summary for LLC versus S-Corp, LLC provides liability support where S-Corporations are mainly for small business revenue with no assets. Well, yes and no. S-Corporations do provide liability protection. It's still a corporate asset or a corporate entity structure that is assigned its own identification number that protects assets separately from your personal assets. The main takeaway, though, I'll give you two really quick examples. The main takeaway here for not wanting to put rental property into an S-Corp is because rental income doesn't pay Social Security Medicare tax, right? It only pays federal and state income tax. Well, when you put a rental property into an S-Corporation, what you're telling the federal government is that that income that you're generating from a rental property, it potentially is self-employed income. And so the government in an audit may actually force you, if they find out that you actively participated in this rental property investment and you are a real estate professional, they might want you to pay 15.3% of Social Security Medicare, playing the reasonable salary ruling game, because the rental property is generated under an S corporation. It doesn't happen very often, probably less than 1%, but you want to keep rental income, non-self-employed income separate from self-employed revenue streams. That's one example. Number two, which I didn't have time earlier to discuss, but because your question came up, I'm going to go ahead and give it to you. When you buy a rental property, let me give you an example. So let's say I set up an S corporation, and after this seminar, I figure I didn't hear the example of not putting a property in an S corporation. So I set up an S corporation. I go out and I buy a $500,000 property. I buy it personally, and then I transfer that property to an S corporation. Well, like I said earlier, LLCs are owned by percent, S corporations are owned by share. When I put that $500,000 property into an S corporation under IRC, under Internal Revenue Code, and under federal legislation, I have now transferred a $500,000 asset and traded it for $500,000 in shares of a corporation. So now the corporation owns the property. I own $500,000 in shares of the corporation. Well, let's say 8, 9, 10 years passed, and that $500,000 property is now worth $1.2 million. Okay, $700,000 in appreciation. And I say, well, I no longer want my corporation to own that property. I'd rather own it personally and split it with my spouse because I just got married, or put my child on title, however I want to manipulate that. So I take the property out of the corporation. I didn't sell it, right? I did not sell the property. I just took it back into my personal name. Well, unfortunately, the federal government sees that as you selling $500,000 of corporate stock, except it's not worth $500,000 anymore, is it? It's worth $1.2 million. And so even though you just merely took the property back, the federal government sees it as a $700,000 capital gain because you bought the stock for $500,000 and you're selling the stock back to yourself at $1.2 million. So even though you didn't get rid of the property, you pay $700,000 of capital gain tax on the distribution of that asset. That is why you don't want to put rental property in an S corporation unless you just kick the can down the road until you kick the can, and you do 1031 exchanges. You never take the property out of the S corporation, and you leave it in death to your beneficiaries. At that point, then the inheritance rules kick in and the stepped-up basis benefit kicks in, but that's a whole other conversation. Those are the two main reasons why you do not put rental properties in an S corporation. S corps are for self-employed revenue. Rental properties and non-self-employed revenue streams are best held in LLCs, but also from a liability standpoint, LLCs are best for protecting large depreciable assets, like you had mentioned. S corporations can have assets. It's just not looked at as the best entity to protect the large depreciable asset. You're welcome, Austin. Absolutely. Any other questions? I know that I've kept all of you in the webinar this long. I must be saying some good information. I don't know. I mean, I get excited about it. My associates get excited about this stuff. It's very important. It gives you power, right? I mean, we didn't write the Internal Revenue Code, but we know how to play by the rules, right? You know, when you're out on a basketball court, when you're out on a football field, you always see the coach drawing up the game plan. The game plan is the tax code. I've had arguments with people in the past, whether they're Democrat, Republican, or whoever else, living in another country. I've argued that the IRS, the Internal Revenue Code, is a set of rules that you have to abide by, but there's very much something called interpretation of the code as well. Some parts of the code may be strict with certain individuals, others who are in other industries who are required to spend certain things on certain expenses may be allowed the deduction that other professionals are not. That is an interpretation of the tax code. And so it is a specific set of rules that we have to follow and abide by, but by no means does the code work the same for every single business owner? It just doesn't. It's impossible for it to apply equally across the board. So just remember that. What is the average cost for setting up an S corporation? Vivian, thanks for the question. Well, I mean, you could go with a LegalZoom. You could go with a local attorney's office. They'll sometimes charge you at LegalZoom anywhere from $450 up to an attorney who might charge $2,000, $3,000, $4,000 to incorporate. So the range is pretty vast. Our firm charges $895 to incorporate. That's from the ground up, gets you your articles of organization or articles of incorporation, gets you your annual bylaw or your bylaw agreement, gets you your annual minute filing, gets you your corporate stamp of approval, gets you your EIN number, your SS4, your DE4 state ID number, gets you everything from the ground up. And it also is the hand-holding process to show you essentially what you're filing with the state of California with the IRS. So but $895 is the cost that we charge. If you need it up and running in 7 to 10 business days, there is an expedite fee at the state level of $450. So if you need the S corporation or the LLC set up right now and you need it ASAP, it could cost you up to about $1,300, $1,400. So how about so LLCs and S corporations, the incorporation fee is the same. Normally, that's how it is across the board. LegalZoom, like I said, might charge a little bit less, but they don't really handhold you through the process of structuring a corporation. So you just need to be aware that when you use a cheaper form of like more streamlined service like LegalZoom, you know, there are things that could fall through the cracks. I'm not going to be fully transparent about that. And I've had to correct a lot of mistakes that LegalZoom, not mistakes, but I've had to correct things that weren't done because a client went to LegalZoom and opted not to do something with a full-blown entity like Robert Hull & Associates or a professional like an attorney or any other advisor. So $895 is what we charge. If you need it expedited, it's $1,345 or $1,400, but that gets it up and running in 7 to 10 business days. All right, everyone. Well, we're getting to that almost 10:10 time. Once again, I have my email in the chat box. I'll type it in again, just in case you didn't see it. It's TonyWatson@roberthalltaxes.com, 818-242-4888. If you contact our office, they'll redirect you to get you set up for that free consultation. These are for you, for your family members, for your coworkers, for your clients, whoever you think needs good tax advice. We are here to help. And I'm not going to really put a value on this free consultation because I think it's invaluable. You know, a lot of people, when they have a chance to talk with an attorney about things for a free consultation, man, you got to take that up. You got to take them up on that offer. With a tax advisor, it should be the same thing. We're not on the legal side, we're on the tax side. And sure, all of the legal stuff that you talk about with an attorney, that's all very, very important. That's for asset protection purposes. But on the tax side, it's all financial. This is to save you money. This is to retain wealth. And I guarantee you that if we all sat one-on-one with each other and I asked you all the same question, hey, are you in business to make money or to lose money or just to stay even, right? I guarantee you that 100% of us would say, well, I'm not in business to lose money. I'm not in business to just stay stagnant. I'm in business to give myself a better life, to provide for my family, to create legacy, to be more philanthropic, to travel the world, to play golf on an island, to start a charitable organization, whatever you're going to do with that money. It's all about retaining wealth. It's all about you working hard to create legacy for you, for your family, for our country. And so that's very important for us to realize. And whatever you do with your money, that is your choice. And that was one of the greatest things about the United States of America, is that we can build wealth here. And even though some of us may not agree that it's not controlled, here in the United States, our government is kind of in turmoil right now. There's a lot of misinformation. There's a lot of misguidance. There's a lot of arguing. But at the end of the day, I still think that the United States is one of the greatest places on the face of the planet. As an investor, as a professional, as a father, as a husband, as a son, as a grandson, as hopefully someday a grandparent, a great grandparent, I couldn't imagine any other place being, to be real honest with you. I'll travel the world, but this is where home is at. So anyway, I'll get off my pedestal and we'll talk to you soon. Hopefully you take advantage of this free consultation and we'll be hearing from you soon. Please stay safe, stay healthy, stay sane. We'll come out of this pandemic knowing more than what we knew going in, and that helps me sleep a little bit better at night. And don't forget to vote. Okay, whatever you do, do not forget to vote. If you don't want to vote, that's fine. That's your right. That's the greatest thing, once again, about America. You don't have to vote. But if you are going to vote, vote. Make sure you make that a priority. Okay. Everyone have a great day. Take care, and we'll see you not too far in the future. Have a great day.